what just happened in the silver market, because there's something unfolding right now that people really need to understand. I was checking the COMEX data this morning, the same routine I do every day, and something stopped me cold. January silver open interest doubled in a single session. 223 contracts added just like that, bringing the total to 493 contracts with only 5 trading days left in the month. Ladies and gentlemen, Asian guy here. While everyone is celebrating silver crossing $100 per ounce, the real story is hiding in the January contract, and it tells you exactly why this move may not be stopping at triple digits. January is not a primary delivery month. It's the dead zone between December and March, where open interest normally collapses as traders roll forward into active months. That's how this market has behaved for decades. But instead of the usual roll-off, we just saw open interest spike by over 1 million ounces worth of contracts right before expiration. That is not normal market behavior. That's not speculation. That's participants who cannot wait another week to secure physical silver, let alone wait until March. As of market close on Thursday, January 23, 2026, silver was trading at $102.18 per ounce, according to Trading Economics, up over 6% on the day. Over the past month, silver is up more than 40%. Year over year, it's up over 230%. And the question everyone is asking is whether this is the final blow-off top or the beginning of genuine physical scarcity pricing. The January open interest data strongly suggests it's the latter. According to analysis from Silver Trade, with silver breaking decisively above $100, FOMO is now entering the market aggressively. At the same time, massive retail buybacks are likely to slow down. That makes sense. Longtime physical holders who endured years of suppression are finally seeing prices they never thought they'd witness. Some will take profits. That should reduce buying pressure, right? Except industrial users don't have that option. They can't just decide not to use silver. Solar manufacturers need it. Electronics companies need it. Defense contractors need it. If they don't secure supply now at $102, they risk facing $120, $140, $160, or worse, not being able to get it at any price. That's why January open interest doubled with only 5 days left. Industrial urgency is overwhelming retail profit-taking. Silver Trade estimates that nearly all 493 remaining January contracts are likely preparing to stand for immediate delivery. That's roughly 2.5 million ounces potentially coming out of COMEX inventories in the final week of what is supposed to be an inactive month. And this comes after we already saw record delivery activity earlier in January. The cumulative drain on registered inventory is accelerating, not slowing down, even as prices reach record highs. The path that got us here tells you everything about the nature of this move. Trading Economics notes that silver's rally has been driven by a historic short squeeze, robust retail demand, and China's tightening export controls. All 3 remain in place, and at least 2 are intensifying. The short squeeze isn't over, it's escalating. China's export restrictions aren't temporary, they're structural. The only variable that might ease is retail demand, and as we've discussed, that's being replaced by industrial panic. The macro backdrop supports higher prices as well. The Federal Reserve is expected to hold rates steady at its next meeting, but markets are still pricing in multiple cuts later this year. President Trump is expected to appoint a new Fed chair, and a more dovish selection would strengthen expectations for monetary easing. Historically, easier monetary policy supports precious metals by reducing the opportunity cost of holding non-yielding assets and increasing inflation expectations. But this rally is different. Silver isn't just responding to macro conditions, it's experiencing real physical stress at the exchange level. According to data analyzed by David Jensen, on January 7th alone, holders of 1,624 January contracts took delivery of 8.1 million ounces, with JP Morgan issuing 99% of those warrants. One bank delivered nearly all the metal that day. What's extraordinary is that despite those deliveries, January open interest actually increased by 1,431 contracts the same day. That means new positions were entering the contract faster than metal was leaving the vaults. Those weren't speculative longs, they were participants rolling backward from March into January specifically to take immediate delivery. Money Metals Exchange analyzed the data and found that open interest in January and February rose by nearly 3,000 contracts, while March open interest fell by almost the exact same amount. Rolling backward costs money. You pay transaction fees and backwardation premiums. The only reason to do that is urgency. You want metal now, not 6 weeks from now. That urgency tells you more about physical availability than any price chart ever could. Geopolitical risk is adding fuel as well. A weakening dollar, driven by rising tensions between the US and Europe and concerns about asset weaponization, is pushing investors toward hard assets. When currencies become political tools, metals benefit. China's export restrictions are the real structural break. As of January 1st, 2026, only companies with proven export histories and massive production capacity are licensed to export silver. That effectively restricts access to a majority of global refined silver supply, because China controls refining, not mining. Even silver mined in Mexico, Peru, or Australia often passes through Chinese refineries. Only 44 companies were licensed for the current period. If that number stays flat or declines, the bottleneck becomes permanent. Silver trade makes a critical point here. Outside of 2 brief weeks last October, silver's move from $30 to over $100 happened without a true industrial panic. Supplies were tight, but users were still operating normally. If this is what prices did without panic, what happens when panic actually sets in? The backward rolling into January suggests we may be seeing the early stages of that shift. This is not retail behavior. Retail doesn't trade futures. Retail buys coins and bars. The players paying premiums to accelerate delivery are institutions and industrial users who need physical metal for operations. When confidence in future availability breaks down, price discovery becomes violent. That volatility cuts both ways. Silver trade warns that silver will rip faces off in both directions. Extreme moves will trigger greed, fear, and forced liquidations. That's why their advice to never use margin is critical. The CME has already raised margin requirements by nearly 50%, and more hikes are likely. That creates artificial selling pressure that can cause sharp corrections without changing the underlying physical reality. A pullback to $90 or even $85 wouldn't invalidate the thesis. It would simply shake out weak hands. There are risks. Some industrial demand becomes uneconomical at higher prices. Jewelry demand may fall. Recession fears could slow consumption growth. Governments could intervene if prices threaten critical industries. These are real headwinds, but they are being overwhelmed by one fact. January open interest doubled with 5 days left to expiration. That is not speculation. That is urgency. What I'm watching next is simple. How many of those 493 contracts stand for delivery? If they do, that's another 2.5 million ounces leaving COMEX inventories immediately. I'm also watching Shanghai premiums. Sustained premiums over COMEX spot would confirm a 2-tier market where physical availability can't be arbitraged away. And I'm watching March. If backward rolling continues into March, this wasn't an anomaly. It's a regime change. 3 takeaways. First, the January open interest surge shows participants paying real costs to secure immediate delivery, signaling near-term scarcity fears. Second, silver's move to $100 happened without true industrial panic, meaning full price discovery may still be ahead. Third, retail profit-taking is being replaced by industrial urgency, allowing demand to persist even as long-term holders exit. The question now isn't whether silver can hold $100. It's whether $102 becomes the floor for the next leg higher. That answer will come from March delivery demand, and we'll know soon. Looking ahead to February 2026, the silver market is moving into a very important phase that could change how price and physical supply are determined. After breaking above $100 per ounce in late January, silver is not expected to calm down or move sideways for long. Many analysts and traders believe higher prices are still ahead, driven by ongoing supply problems and strong demand from industries that rely on silver. This combination is likely to keep volatility high and push prices further. One key change coming in February is the launch of new silver futures contracts by the CME Group on February 9th. These new 100-ounce contracts are designed to bring more participants into the market and improve trading activity. But they are being introduced at a time when the physical silver market is already under pressure. While more trading can increase liquidity, it also raises the risk of sharp price moves. If more traders demand physical delivery while supply remains tight, the market could see sudden squeezes, fast sell-offs, and powerful rallies in a very short time. The physical side of the silver market remains stressed. Global supply was already falling short of demand through 2025, and China's export restrictions are making the situation worse. China plays a major role in refining and exporting silver, and these limits are expected to continue through 2026. This has slowed the flow of silver into global markets and pushed premiums higher, especially in Asia. At the same time, demand from solar panels, electric vehicles, electronics, and other technologies remains strong. Because of this, physical silver is becoming harder to source than paper prices suggest. February also brings broader economic forces that could support higher silver prices. Investors are closely watching the Federal Reserve, as markets expect easier monetary policy later in the year. When real interest rates stay low or negative, precious metals like silver tend to benefit because there is less disadvantage to holding assets that do not pay interest. Ongoing geopolitical tensions and trade risks are also pushing investors toward hard assets that are not tied to any one currency or government. However, February is unlikely to be calm. The market is facing real risks of sharp price swings. Recent increases in margin requirements by the CME have already caused sudden drops and forced selling in futures markets. If prices rise too quickly, more margin hikes, technical selling, or profit-taking could cause temporary pullbacks. These moves may look dramatic on price charts, but would not necessarily mean that physical supply problems are easing. Because of all this, many market participants see February not as the end of the move, but as a key turning point. Tight supply, strong industrial demand, backwardation, and rising urgency among buyers suggest the silver market could stay volatile and elevated. If these pressures continue, February may set the foundation for even higher prices as the market moves toward true physical price discovery beyond $100. 3 takeaways. First, the January open interest surge shows participants paying real costs to secure immediate delivery, signaling near-term scarcity fears. Second, silver's move to $100 happened without true industrial panic, meaning full price discovery may still be ahead. Third, retail profit-taking is being replaced by industrial urgency, allowing demand to persist even as long-term holders exit. The question now isn't whether silver can hold $100. It's whether $102 becomes the floor for the next leg higher. That answer will come from March delivery demand, and we'll know soon. Drop your thoughts in the comments. Are you holding physical through this volatility? Did you take profits above $100? And what do you think this January open interest surge means for COMEX's ability to meet delivery? Hit like, subscribe, and stay tuned, because this is the most important price discovery period silver has seen in modern history. And remember this, silver is not a luxury metal. It's a strategic material. When markets finally stop pricing silver as a speculative trade and start pricing it as an indispensable industrial input, the old valuation models break completely. Price won't be discovered on charts anymore. It will be discovered in warehouses, delivery notices, and who gets metal and who doesn't. When that shift completes, silver doesn't move slowly, and it doesn't ask permission.